All right, today we're covering ESPPs, Employee Stock Purchase Plans. So by the end of this video, I want you to better understand what these are and why you should participate. In general, if your employer offers an ESPP, we think you should participate at the level you can comfortably afford and then sell the shares as soon as you can. This strategy allows you to lock in a return on your contribution while avoiding taking additional risk on your company's stock, which may already represent a large chunk of your net worth. However, on the flip side, I personally know some people who prefer to take on more risk and hang on to their company stock, so I get that part. While I don't suggest it and wouldn't personally do it, if you're financially secure so much to the point that seeing a 50% drop in your company stock wouldn't necessarily affect you, that strategy might be for you. In this video, we'll show you why this strategy makes sense by answering some basic questions. What is an ESPP? How does an ESPP work? Should you participate? How are ESPP gains taxed? When should you sell the stock that you purchased through an ESPP? All right, first one. What is an ESPP? An ESPP is a benefit that offers you the opportunity to purchase shares of your employer's stock at a discount, often up to 15%. Employees contribute to the plan through payroll deductions, which then build up between the offering date and the purchase date. At the purchase date, the company then uses the employees' accumulated funds to purchase stock in the company on behalf of the participating employees. ESPPs are only available to the employees of publicly traded companies. And while not all public companies give you the option to participate in this ESPP, many of them do. Now, secondly, how does an ESPP work? First, you decide what percentage of your paycheck you would like deducted to buy your company stock at a discount. The IRS limits you to a maximum contribution of $25,000 each year, although your employer may cap your contribution at a lower amount or percentage of your income. Unlike regular 401k contributions, your ESPP contributions are withheld from after-tax income, similar to how, Roth 401k plan contribution will work. Once you enroll, your payroll contributions accrue during what's known as this offering period. Your offering period will be broken up into purchase periods, which are generally 6 months long. At the end of the purchase periods, your employer uses that accumulated contribution amount to buy shares for you at that discount. For example, you could have a 1-year offering period starting on January 1st, 2022, with 2 6-month purchase periods, one ending on June 31st, 2022, and then the second ending on December 31st, 2022. Your shares get purchased on the last day of each purchase period. Many plans also have a look-back provision, which makes them even more attractive. This look-back provision allows you to apply whatever discount your employer offers to the lower of two numbers: the price on the first date of the offering period or the price on the last day of the purchase period. This rule may help increase your benefit if the stock price has gone up during the offer period. A 15% discount on its own is pretty nice, right? But the ability to apply that discount to the minimum of two prices makes ESPPs even more compelling. For example, say your company begins an offer period for an ESPP with a 15% discount. At the beginning of the offer period, the stock price is $10 per share. If the price increases to $15 per share on the purchase day, your 15% discount would be applied to the $10 price at the beginning of the offer period, meaning your purchase price would be $8.50 per share. Should you participate in an ESPP? The short answer is yes, as long as you can afford it though. The discount typically justifies participation as long as you can afford to live on the smaller paycheck you receive as a result of the payroll contributions. If you can afford it, you may be better off maxing out your withholding limit to take advantage of this. If you cannot afford it, make it your goal to get into a better place so that you can participate in the ESPP plan next year. In most cases, participating in the ESPP puts you in a great position to build long-term wealth. All right, so how are ESPP gains taxed? Your ESPP contributions are taxed as ordinary income, which currently tops out at a marginal rate of about 37% at the federal level. If you hold your shares for more than a year after purchasing them and more than 2 years after the beginning of the offering period, then any profit above that gain for the discount will be taxed at the capital gains tax rates, which currently top out at 20% at the federal level. That's the long-term capital gains rates. Any gains solely attributed to the discount are taxed as ordinary income at the time of sale. For more detail on how ESPP gains are taxed, check out TurboTax's resource on the subject linked in the description below. When should you sell ESPP shares? So it can be tempting to hold on to ESPP stock because of the opportunity to benefit from lower tax rates, to get that long-term capital gains rate. But we encourage you to resist that temptation. The stock could decline in value and you could regret your decision. Instead, We think you should use the discount structure to lock in the minimum semi-annual return plus any upside from appreciation, and then sell immediately on the same day that you purchase. If you do this, you already get a generous return, typically around 15%. You don't need to take more risk by holding it longer than necessary. All right, so the bottom line on ESPPs. An ESPP with an embedded discount is a great employee benefit. If you can afford it, you should participate up to the full amount and then sell the shares as soon as you can. You might even consider prioritizing your ESPP over 401k contributions because your after-tax returns could be higher. For more information about equity compensation, check out our other videos and blogs on Wealthfront's Guide to Equity and IPOs. I'm Tony from Wealthfront. Hit that subscribe button and check out more videos below.